I think we have a quorum. So thank you everybody for joining us for our quarterly market review and outlook. I am the Chief Investment Officer here at Kestra. Our team spends a lot of time thinking about markets and portfolios and working with financial advisors to help you guys achieve your financial goals and dreams. You'll see our lovely disclosure slide right here, so my compliance department will be very happy. We'll be spending some time talking about what's happened in the market lately. And as is often the case, the past quarter has offered us a lot to talk about. We'll spend some time talking about where we are in the economic cycle, kind of what's working, what's not working so well. And then we'll look a little bit more deeply into the market itself, particularly stocks and bonds. So as we get started, though, I think it's always helpful to get folks talking a little bit. So if you look on the bottom of your screen, there should be a little box with a question mark in it. That's a Q&A box. You might have to hit the more on the bottom of your screen in order to find that box. But if you click in there, it'll pop up a window and you'll be able to type in questions as we go. So feel free as I'm talking about things, plunk questions in there. I'll try to address things as we go. And then we'll have a few minutes at the end too to address anything else I may not have gotten to. But for now, if you would pull up that box, and you'll see we have a question on the screen saying which group of stocks had the best returns in Q1. And as you guys are typing in those questions, I see another one asking about a copy of the presentation. So the answer is yes, we'll have a copy of this presentation available, which we can email out afterwards. So if you recall, during the first quarter, it was the beginning of March when the Iran conflict happened. So with that, a lot of markets took a big step down. So it was there were a lot of pushes and pulls, and we'll dig into that a little bit in terms of various parts of the market reacting very differently to the conflict in Iran. And so I see here a guess of non-US developed emerging markets. Someone else is guessing US stocks. And the answer is emerging markets, which might be surprising because this is the area of the market that actually got hurt the most during the Iran conflict during March. But if we look at over the course of the first quarter, if you remember, January, February, the markets were actually doing quite well overall. Emerging markets did the best. Non-US developed was second best, and then the S&P was trailing. Now that leaderboard is actually consistent with what we saw in 2025, in that emerging markets did the best, non-developed ex-US, so think like Europe and Japan did second best, and then the S&P 500 was lagging. So interestingly, even with the big downturn in March, we had that fairly consistent experience. So you'll see the US, which is represented by the S&P 500, was down about 4% in the first quarter. Emerging markets were about flat. Developed ex-US down about 1%. And again, considering what's happening politically, markets have been fairly stable. And again, we'll take a closer look at the impact from the conflict in a moment. But I'll highlight that fixed income. So those are those middle bars that you can barely see because essentially most of the fixed income world was also flat during the quarter. We'll talk about some positives and negatives there. And then I'll point out that high bar there on the right, which is commodities. So a large portion of that commodity rise during the first quarter was oil, but we've seen other commodities rise as well. Agricultural commodities have increased. Oil-based products are a big input to the agricultural process, and that started to drive some prices higher. So let's take a quick look at what happened in March, because again, what happened in January, February versus March was quite different. So you'll see essentially the conflict started at the beginning of the month. S&P was down 5%. Emerging markets down 13%, so a very steep drop. And then Europe and Japan down about 10%. And you'll see commodities up 11%. Remember, for the whole quarter, they were up 24%. And that's really because oil had started rallying before the conflict, partly in anticipation of a potential conflict. So what we saw is that these emerging markets, these non-US markets, were much harder hit during the conflict simply because many of them are big consumers of oil. So if you think about the US economy, we are actually net exporters of oil. I know it doesn't feel like we're insulated from high oil prices when you go and try and fill your gas tank. I did mine the other day and it was like 70 bucks. So that hurts. But a big part of our economy are energy companies who benefit from higher oil prices. So with that, let me ask one other quick question, which is out of 11 sectors in the S&P 500, how many were positive in the first quarter? So think you have like technology, communication services, healthcare, utilities, real estate, commodities, financials, consumer staples, consumer discretionary. I think that might be everybody. Materials. So of those, how many do you guess were positive in the first quarter? And remember, the S&P 500 overall was down about 4%. So we have a guess of 5, 6, 5, 4. You guys are pretty close, pretty close. So of all of those 11 sectors in the S&P 500, 6 were actually positive for the quarter. So if we take a look at the quarter overall, you'll see all the way over on the left, energy was up 40%. Energy companies, their profitability is very, very tied to the price of oil. So as oil prices were rising, so too does the profitability of those firms, and the stocks anticipate that. So those stocks rose a lot. But you'll also see some areas like utilities, consumer staples. These are often areas that investors will go to during times of trouble. So if they're worried about people maybe not being able to spend as much, utilities and consumer staples are areas that are less likely to be cut back when folks' paychecks are being hit. You'll see over on the right things like information technology, communication services. This is where, if you've heard about the Magnificent Seven, this is where those stocks live. These are two sectors that have really driven the market over the last 3 years and have been a very, very important driver of overall S&P 500 returns. We'll take a quick look at the fixed income side. Before that, sorry, Neil, if you don't mind. Yeah, so in March, so again, this is really important. This is where the market started to take a real U-turn. You'll see energy on the left still up 10%. But then over towards the right, you have things like healthcare, consumer staples. So these were areas that got hit more during that time of stress in the market. Turning to fixed income for a moment. So bonds tend to move a lot based on what's happening with treasuries, right? So treasuries are when the government wants to borrow money, they put them in a treasury bond or a bill and bring that to the market. As things like inflation expectations change, as expectations for economic growth change, as expectations change for what the Federal Reserve will do, these yields move. So that dark line on the bottom is where Treasury yields were at the end of 2025. And it's for different periods in time. So all the way over on the left, you'll see a 1-month bill yield. All the way over on the right, you see 30-year. So if the US government is looking to borrow money for 30 years, and they issued a bond at the end of last year, there was a almost 5% yield on that. But if they only wanted to borrow money for a month, that yield was about 3.7%. So as different expectations for the economy move, so too do these yields move. So then that light blue line is where yields were at the end of the third quarter. And you'll see in general, interest rates were up a little bit during that time period, but the part that moved the most was right around that 2-year. So you'll see that big kind of rise in the middle part of that curve. That is changing expectations for what the Federal Reserve will do. We started the year with the market expecting that the Federal Reserve would cut interest rates twice during the course of the year. Essentially, as the conflict started in March, all of those rate cuts got priced out, such that by the end of the quarter, the market was not expecting any change in Fed rate cuts at all. And so that 2-year tends to be where we price in those expectations for the Federal Reserve. So just something to note as we look at some of these other numbers. So with that, let's turn to the economy. I grew up in this business with one of my very early mentors drilling into my head, don't fight the Fed. So as I said, that there was a big change in market expectations about what the Fed was going to do. And that's a really important part, a very important driver of where the economy is growing. So we developed this dashboard to just think about what are the most important areas of the market, where are we? Because sometimes you can have very different experiences in different part of the economy. So monetary policy, though, tends to be the driving force. And as you look at that kind of like range of where we are, you'll see that we're pretty much in the middle. And in fact, that's true for most of the areas that we're looking at here. And that's a pretty good place to be. You don't want an economy that's overheating, where everything's over in the green, and you also don't want an economy that's all in the red. That would suggest that we're in recession. So monetary policy, we're towards the green end of that, where the Fed is somewhat accommodative, but we did pull it a little bit more towards the middle as the market started to price out expectations of 2 rate cuts. On the manufacturing side, even though those two levers are in the same place, manufacturing has actually been moving a little bit more into the green. We'll talk about that in a moment. The consumer is facing some what I would call asymmetric pressures, where you have a higher end consumer that's doing quite well, lower end consumer that's continuing to see additional pressure. Housing is one that has moved more recently into the red. We'll talk a little bit about why, but affordability issues, high interest rates have been a drag there. And then labor, we actually see is relatively neutral. Even though labor market is decelerating, it's at a relatively healthy level, which seems a little bit at odds with a lot of the headlines that we see. So let's take a closer look at inflation, because that's a really important driver of what the Fed is doing. So you'll see here, this is the most common measure of inflation. So core consumer price index, it takes out food and energy. Now, food and energy actually make up a lot of our wallet share. That tends to be what we spend a lot of money on, but those prices tend to be very volatile. And also those price increases are often transitory, very much like what we're seeing with oil right now. So to get a better sense of what's happening underneath the hood, economists will take out those food and energy prices to get a sense where other price levels are. So you'll see that big peak up after 2020. That is the COVID-related increase in prices. Quite painful, one of the highest levels of price increases that we've seen going back to the 1990s. And so you probably remember, shopping for eggs and steak and being a little alarmed at what the price was when you got to the checkout counter. From 2021-22, those prices have, or I should say price increases have slowed. So that doesn't mean prices declined, but the price increases have slowed, such that as of March, our core CPI reading was about 2.6%. So that is a much, much healthier level than what we were at a couple of years ago. That said, it is still above what the Fed says is ideal. The Fed has been saying for a number of years that they want inflation back to 2%. We think that's going to be quite hard. And of course, now with oil, to this morning, it's trading at about $105 a barrel. With oil higher, that's going to be more of a challenge, because the longer oil stays high, the more likely it is to get priced into these other types of goods as well. That said, as we're having this kind of continued somewhat inflationary pressure, we have started to see manufacturing activity accelerate. So this is, I love all my economic indicators the same, but I might like this one a little bit more. This is a really helpful way of looking at broad trends in the economy. It's a very quick measure. A lot of economic data we have to wait a long time for. This we get within weeks of it being gathered. So that blue line is the Institute for Supply Manufacturers index on manufacturing. So what they do is go out to manufacturing companies, ask them a list of questions, but in general, is business better or worse this month than last month? So you can see that blue line was hovering below 50 for a bunch of years. This suggests that manufacturing activity was declining. Anything below 50 means that manufacturing activity was declining. And we've kind of been bumping up against that 50 level for a while. And then over the last couple of months has finally reached above that 50 level, suggesting that we've gone from contracting to expanding. That gold line you see there is services. So the services economy has been consistently above 50, has been quite robust, and has also seen a recent acceleration. But this suggests that heading into this conflict and this like shock of higher oil prices, the US economy was actually in fairly good shape. And we have plenty of other ways of measuring it as well, but this is a really easy way of showing it. So there was a fair amount of economic momentum heading into that March time period when oil suddenly increased. And by the way, when we look at this same measure for other economies outside the US, something like over 70% of all countries around the world are seeing these numbers also in positive territory. So again, that suggests that it's not just the US, but the globe that's actually has some good economic momentum behind it. Another economic data point that's really important is looking at retail sales. So this really reflects what people are spending. So here we're looking at real retail sales. So we're taking out the impact of inflation. We're also taking out autos, which tends to be quite volatile. So how much are individuals spending once we take inflation into account? And what you'll see there is that we had a big decline when rates were rising heavily. And now it's bouncing around 1-ish% positive year over year. So that's a reasonably healthy level of spending for individuals, and suggests that even though when we look at confidence measures, so when we ask people, how are you feeling? They're saying not so good. Most people are out there actually still spending. Now, an important contributor to how much people are willing to spend is how they feel about their jobs. And as I mentioned earlier, like I often talk to people and they react to a lot of headlines that are out there. I just saw today, Microsoft offering buyout packages, Amazon talking about laying people off. There are a lot of headlines that suggest that there are a lot of layoffs happening in the economy, but the broad numbers are not picking that up. So what you see here is the most common way that we measure unemployment. And so it's looking at how many people are unemployed relative to how many people are in the labor force. So how many people are either working or looking for work. And what you see there is that over the last couple of years, that rate has been increasing, but that it's well below that red line, which is the average during expansionary periods. So even though it's becoming a little bit harder to find a job, it's still much better than during many other periods of American economic history. And I want to address, there's a question that came up in the box here. How much of the increase in manufacturing spending is inflation versus real growth? So this is a good question, right? Because when we looked at the retail sales, we took out inflation, and we can see very easily kind of what's happening outside of that. When we look at manufacturing activity, they are definitely feeling inflationary pressures. So if we look at, there is a specific question that asks about prices. So how much is a manufacturing company paying for inputs to make whatever it is that they make? Those prices are going up. So this is definitely a challenge. But I would say that those prices have been increasing for quite a while. And it's only recently that we're seeing overall activity increasing. So inflation is part of that increase, but not all of it. So hopefully that helps. All right. Another really important part of the economy that can be very difficult to measure is on the small business side. So small businesses make up the majority of employers, or they're the majority of jobs that are out on the market. So what they're doing is a really important driver of the broad economy. But because they're small, they're hard to measure. So this is, again, like a fairly quick survey that's been around for a long time, where small business owners are asked a series of questions. And then they get rolled up together to come up with this optimism index. And so what you'll see there is that in late like 2024, 25, you can see a nice rebound in optimism. But beginning about a year ago, that optimism started falling again. So things like tariffs have been a big headwind for a lot of these businesses. The OBBBA, which was meant to encourage CapEx spending, was a positive, but that's sort of been overwhelmed now with the higher oil prices. So these have been really impactful for small businesses and have made it hard to kind of navigate around. I mentioned earlier that housing had recently been moved a little bit further into the red for us. And so you can see here, mortgage rates have been a really big impact overall on the housing market. So on the left, we have mortgage rates going back to 1971. Hard to imagine, but back in the 1980s, my parents had to pay an interest rate on their mortgage of almost 20%. It's hard to imagine that today. But we got as low as 2% during COVID, which was quite remarkable. And then as interest rates started to increase, so too did that mortgage rate for homeowners start to increase quite significantly. So got almost as high as 8%. On the right, you'll see just a zoom in of that same measure. So beginning at January 2025, we started at about 7%. and have gradually drifted down over the subsequent 12 months or so. And then the Iran conflict hit, interest rates started to increase, and you saw mortgage rates tick back up again. So some of this progress of declining mortgage rates has then been undone in the near term. Now, that's not the only driver of the housing market, but certainly puts a real cap on how much activity that we should be expected to see. I often get asked a lot about government debt. And this is a much longer term issue. On the left, you'll see federal debt as a percent of GDP. So, what we're looking at, how much does the government owe relative to the size of the economy? And what you can see is that big, huge spike in the late 1940s related to World War II spending. So, not uncommon as a country goes to war, spending really ramps up as we, have to pay soldiers, as we build munitions, that sort of thing. But then post-war really came down significantly and then started to tick back up again in like the early 2000s. During that time period, though, what's interesting is that it happened as interest rates were declining. So what happened is that the borrowing cost, or how much the US government was spending to service that debt, actually went down. So it was fairly easy for the US government to be able to service that debt and pay its bills on a regular basis. Now, just as we were looking at those mortgage rates, just as it's more expensive for a homeowner to take out a loan to buy a new house, so too is it more expensive for the US government to borrow. That said, we keep spending. I always say this is not a party problem. This is very much an American problem. Democrats and Republicans both really like to spend money, and nobody likes to cut back. So on the right, you will see federal deficit as a percent of GDP. So this is thinking about how much are we spending on a relative basis compared to how big the economy is. So you'll see there, and in general, that number has grown increasingly negative and is expected to continue to get even more negative. That big drop down is related to COVID, all of those stimulus checks that were sent. But in general, this just shows how we continue to spend a really large proportion of the overall economy, and it becomes a very intractable problem. So this is an issue. It will continue to be an issue. It's not going to be easily addressed, but has an impact on longer term interest rates. I will also point to the US dollar as a really important driver of overall returns, particularly for those of us who have exposure to non-US stocks. So on the left, you'll see the dollar index. So this is the dollar relative to some of the largest currencies in the world. And you can see it goes in long cycles, right? So it's not always in one direction or the other. But starting from about the time of the financial crisis, the US dollar has had an extended period of appreciation. Then last year, things changed a little bit. So you'll see in the first quarter of last year, a big downdraft where the US dollar lost about 10% of its value relative to other currencies. And then it's kind of, bounced around the bottom since then. Interestingly, despite the conflict in Iran, which you might think might drive the dollar down, we've actually seen dollar strength more recently this year. But in general, it's been about range bound for the last 12 months. So then as we think about the impact of the US dollar on international markets, I mentioned earlier that EM has been, or emerging markets have been the strongest performer over the last 15 months or so. You can see here, so MSCI World ex USA, this is a very broad market index, and we take out the US. You can see that very strong performance in the first 2 months of this year, and then as the conflict started, really come down, and then the U.S. dollar that's moving around a little bit, not quite so much, but sort of contributing to that over time. I'll end the discussion of the economy just taking a quick look at oil, which is, so this is looking at Brent crude. There are different measures of oil. This is the one that's most often used for Europe. And you can see, again, I always like looking at really long data sets to get a sense of where we are. So you can see back in the 1970s and 80s, those were periods of massive supply shock, where you had huge increases in oil. It doesn't look that big right now because we're looking at it on a nominal basis. But, I certainly remember when I was a kid lining up at the gas pump to fill our gas tanks because there was rationing. The US at that time was a huge importer of oil. So we were very, very kind of subject to these international markets. It was very difficult for us to manage through. But you'll see some other periods too where we've had big spikes in oil, notably in like 2008 or so. And of course, all that volatility around COVID as well, where oil prices briefly went negative, where there was no place to store it and nobody was using it. And then that huge bounce back too as inflation really headed north. Now you'll see that very quick hook up. Brent crude prices year to date are up about 80%. That is a really, really huge shock to the markets. Now, I will note that Brent started the year at $60 a barrel. So that's quite low, even relative to the last couple of years. And Brent crude started rallying even before the conflict, partly because markets were anticipating the possibility of a conflict, but also partly because demand for energy is increasing, partly because of all this demand for AI computing power. So it's these two forces kind of colliding, and then of course, blockade of the Strait of Hormuz, and those prices have really increased significantly. Now we're off the peaks of, I think it was $132. Today we're trading at about 105. So, we'll be bouncing around that level. I will note that futures markets, I haven't checked them this morning, but as of a couple of days ago, futures markets are anticipating that these oil prices will go back to $80 by the end of this year. So most market participants are anticipating that this conflict will wind down at least enough for traffic to start going back through the Strait of Hormuz and for some of those prices to settle back down again. But that is a very important driver of some of these relative returns. So let's take a quick look at the stock and bond market. It's been hard over the last couple of years to not talk about AI. It has been a massive, massive driver of both market returns and economic growth. That said, we've been talking for a while about this idea of market broadening. So if you look the S&P 500 over the last 3 years, close to half of the returns over that time period are from what we call the Magnificent Seven. So think, like Apple, Amazon, Google, Nvidia, Meta, Microsoft. These are all companies that are really at the forefront of building AI, using AI, delivering AI to customers. But interestingly, starting in January 2025, we started to see hints that the market was changing its focus from those particular names who are like at the very forefront of introducing AI to other areas of the market that had lagged behind. So you'll see in the beginning part of last year, that blue line is the Magnificent Seven overall. Those seven names had actually started to underperform the S&P 500 even before the tariff announcements in April. When the tariffs were announced, then you saw a big drawdown in the overall market. Mag 7 started to come back again, but then beginning at the end of October of last year, the S&P started pulling ahead and the Mag 7 started lagging. So this is important. I think it's an important reminder that the market won't always be this Magnificent Seven. They are really important companies, and we'll talk a little bit about their impact on the economy overall. But it's not all about them all the time. And it's really important that as an investor, you have exposure to not just those big names, but also other areas of the market. So if you will, pull up those question boxes again. And if you will, which Mag 7 stock performed the best in Q1 and what was its return? So again, we have Nvidia, Apple, Meta, Microsoft, Tesla, who am I missing? Google. I'm missing one. Hopefully you remember. So let's see. So we have Apple, Tesla, Nvidia. Okay. So actually, the best performing Mag 7 stock in Q1 was Apple, and it was down almost 7%. So again, it just goes to show you that these names aren't always at the top of the leaderboard. Now, again, these are great companies who have been battle tested and have important products that they offer, but they're not always the ones who are driving these returns. That said, I mentioned earlier, they're incredibly important, not just for the market, but for the economy overall. And so this is one measure of how we're seeing the spending by these companies make their way into the broad economy. So this is simply looking at how much money is being spent on computer equipment relative to the size of the economy. So you'll see back in 2000, we approached, a little over 1% of the economy is being spent on computers. Only recently did we reach that same level because of all of this AI related capital spending. Now, you may have heard some of these numbers, hundreds, even $1 trillion expected to be spent on CapEx related to building out, whether it's like data centers or investing in AI, new chips, whatever it might be. But this has become an incredibly important driver of overall economic growth. With that, I want to turn for just a moment to the impact of the Iran conflict on overall markets. So, when we think about this AI related investment, this is a very long-term driver of the economy. This increase in oil prices was a very quick shock. And so, it's helpful to look at how different asset classes perform during this period. So those gold bars are showing what happened in January and February. And you can see small cap did well, value did well, emerging markets very strong, up 15%, Europe and Japan up almost 10%. But then you had almost a mirror image during that time period in March, where the areas of the market that were doing the best actually took the hardest hit, right? Emerging markets down 13% in March alone. I will highlight on this idea of broadening. If you look closer at US growth, you can see that those stocks were down almost 5% in January, February, and then another 5% in March. This is where the Mag 7 live, right? So this is telling us there's something longer term that's impacting the stocks within US growth, right? They're not just reacting to the conflict in Iran, whereas these other areas of the market are. They're being hit specifically by this news event that's happening. Now, I'm seeing a question here. What are thoughts on the price of oil being above $100 consistently as a leading indicator for a recession? So this is a key question. And this question will determine what happens to those bars going forward. I've mentioned this a number of times in other places where the level of oil price that we get to on any given day is much less important than how long we're at that elevated price. So I mentioned today we tipped back above $100 on some news headlines that the US was going to be more aggressive in the Strait of Hormuz. With that, oil prices went up. If we stay at that level, that will be negative for the market overall. The market right now is anticipating that oil prices go back down to $80. So that's like, we talk about the market pricing that in. So if that's what we follow, right, oil prices go back down to $80 over the next like 8 or so months, that will unfold in a way that the market is priced for. If oil is above or below that, then that changes the market. So in general, if oil prices stay at $100 for an extended period of time, that will be a headwind for the US economy and the global economy. It will be much easier for the US to handle high oil prices than it will be many other parts of the world. Those parts of the world that are big importers of oil are much harder hit. So again, remember that in the US economy, we have the offset of energy companies that benefit from high oil prices. Now, if you're a consumer who has to pay a lot to fill their gas tank, that will really hurt. So in general, yes, that high oil price is a negative for the US economy, but it has to be there for a long time. And again, on a relative basis, we'll be better able to withstand it than other parts of the world. Okay. So the other thing that's really important to remember, I know we have we're very focused on the conflict right now, which makes a lot of sense. And oil prices are a pain point. But ultimately, the US market or any stock market is going to respond to how much they think companies can earn over time. And so that's why the earnings power of these companies is really what's most important. So you'll see here, this is expectations of how much companies in each of these different indexes are expected to earn. So for full year 2026, how much will they earn relative to the previous year? You'll see these move over time. And they move because analysts are updating their estimates, right? Okay, tariffs come out. I have a company that imports a lot of textiles from China. They're going to have to find other sources. That's going to be more expensive. I'm going to bring their earnings down. On the other hand, they might see like, oh, they're introducing this new product. They've been able to increase their prices. We're going to increase earnings expectations for this year. So that light blue line is S&P 600. So small stocks. You'll see that those earnings expectations have come down. The gold line is mid-cap stocks. Those have also come down. Now, I will note that that usually happens. Earnings expectations usually start high in the beginning of the year, and it's just because people are naturally optimistic and then they come down. So this is not necessarily outsized what we might expect. But interestingly, large cap stocks, so these are some of the largest companies in the US, you will see have actually been increasing starting at about June of last year. Analysts have been increasing how much they think that these companies can earn. And you'll see all the way over on the right, all of those expectations for small, mid, and large have started to increase, suggesting that the market believes and companies are showing that they continue to earn and grow their earnings over time. And ultimately, that's really what matters to the market. All right, so let's take a look at valuations because it matters not just what companies are earning, but how much are you paying for it? And here's where we're looking at valuations comparing US to other parts of the world. So those blue bars are the range of valuations. So what's the price of the stock relative to how much it's earning? What's that range over the last 10 years? So you can see in the world overall, average PEs, we call it, so price to earnings, have ranged from about 23 to call it 8. That line there is the average over the last 10 years. And then that blue dot is where we are right now. So if you look over to the US, that blue dot is well above the average. So it's not the most expensive we've been, but it is pretty high relative to our average levels. Once you get to Europe, UK, it's mildly above long-term levels. And then emerging markets, China, current valuations are actually below average. So we think this is actually an opportunity, and non-US offers some really interesting value, assuming that oil prices begin to recede, right? That's really important for some of these companies to be able to get back to earning again. I'll take a quick gander on the fixed income side. Here we look at very closely spreads. So this is important to look at. We talked earlier about treasury yields. So, how are expectations changing in terms of economic growth and inflation and whatnot? Credit spreads are going to reflect what the market thinks about how safe it is. I'm lending money to this company. How likely is it that they're going to pay me back over time? So investment grade are, very large, diversified, mature companies that the market doesn't worry about too much. Think like IBM and Apple. These companies, are very reliable. They always pay their bills. So the amount that, say, like an Apple or an IBM has to pay above what the US government has to pay is that investment grade spread. That blue line is high yield. So think of a more untested company, somebody who's less diversified, maybe has less history. The market is more worried that they're going to actually pay their bills. So they're going to have to pay more. They're going to have to pay a higher interest rate. Think like subprime versus prime. And over time, the market will change. So you can see like during the financial crisis, 2008 or so, you can see the number got really high. So the market was very worried that these smaller untested companies were not going to pay back their loans. So they were requiring a really high yield. Over the last couple of years, you can see this number is really low. So the market is not really worried that companies are not going to be able to pay back their loans. It's hard to see, but earlier this year, there was a mild uptick in this. So you may have seen headlines about private credit issues. So these are loans that are made outside of public markets. They're usually between two entities or maybe a couple of different entities. And there's been concern that there are credit issues. This has bled a little bit over into public markets, but mildly so. So it's something that we're tracking very closely, but right now, very little stress is showing up in those markets. I will note, we've gotten a lot of questions about how geopolitical conflict impacts US markets. And so we did this exercise looking at what happens in the S&P 500, so the largest measure of the US stock market, after a big geopolitical event. We went back to 1940, where I identified 44 different ones, and they range from, World War II to like Bay of Pigs. And we tried to identify things that were international in nature, and to be able to then look at what happens to the market 1, 3, 6, 12, 24 months afterwards. And now World War II was a big exception, but on average, what we found is that over these 44 different events, the market tended to be up over time. So these numbers here represent the median return across those 44 events. And you can see 12 months out, the median is about 10% positive after a geopolitical shock. 24 months, it's up 17%. And in fact, of those 44 instances, 73% were positive. So what does this tell us? This tells us it's a great way of demonstrating how the US is very insulated from geopolitical shocks. We are incredibly fortunate in that we only have two countries that border us. We have massive oceans on either side. As I mentioned, we are now a net exporter of oil. And so we have the ability to withstand these types of shocks in a way that many other countries don't. They might have 8 hostile borders, right? They might import the majority of their food. It is much more difficult for those countries to be able to ignore a geopolitical shock that's happening somewhere outside their borders. But this is the great benefit of being a US investor. And again, it doesn't mean that these things aren't important. They are, and they are very important for kind of like the world order, and they do transmit through oil prices. But in general, US markets tend to recover fairly quickly after these types of shocks. I'll end on one last slide, which tends to be one of my favorites. And this is a great long-term view of different types of asset classes. And I like this because, as I said earlier, I always find it helpful to get as much history as possible and to get a sense of kind of how our current experience compares to long-term historic experiences. And what you see here is that stocks far and away are the best way of growing wealth over time. Day to day, stocks can have a fair amount of volatility. And as an investor, it's really hard to watch that on a regular basis and to have faith that over time we're going to sort of like reclaim this long-term trajectory. But what you see, that red line, is that after inflation, so that's really helpful in this, it goes back to 1800 or so. But Professor Jeremy Siegel, who put this data together, took out inflation so that we could compare different periods. Once you take out inflation, the US stock market over time has fairly consistently grown at about 6.6% from one year to the next. That means that you're able to grow the buying power of your portfolio by nearly 7% year after year. So as you think about kind of like your long-term goals, wanting to retire or buy a lake house to hang out with your grandkids, whatever it might be, stocks are a really helpful engine for being able to grow wealth over time. I'll show bonds there. They don't grow as much, but much more stable day to day. So as you get closer to kind of an event where you might need access to cash, that is a really helpful stabilizer for your portfolio. So with that, I see a couple of additional questions have come in. So let me just scroll through those. So we're hearing two different sentiments from the Iranian and US leadership on conflict resolution. As we climb the escalation ladder, is it possible we see energy lockdowns in Europe and Southeast Asia? So if the conflict persists and we continue to have high oil prices, we've already seen rationing of oil in some different areas of the world, particularly East Asia. So yes, I would anticipate that we start to see more clampdown on usage of oil over time in these other areas. Now, the other thing that I will say is that, I'll confess, I started off my career as an international political analyst before I ended up on Wall Street, and so I find this stuff really, really interesting. But what's important to remember is that as you think down all of these impacts, they become quite onerous, not just for the US, but for our trading partners and the global economy overall. And so there are a couple of sort of limiters on how long this conflict can go on. One that's very important is related to US politics. So we have midterm elections coming up in November. I look at these data polling regularly to kind of get a sense of what popular opinion is. And I probably don't have to tell you guys, but this conflict is very unpopular. And what that means is that there's a lot of concern heading into the midterm elections that if this conflict is still going on, it's going to show up at the ballot box. So there is a big incentive for this administration to wind down the conflict relatively soon so that we can start to see oil prices come back down again. The other limiter is because of supply chains that have become very important to the US economy. So almost all of our semiconductors are made overseas, specifically in East Asia, in those areas that have been among the hardest hit by high oil prices. That is where we started to see already some energy rationing. What will happen eventually is that high oil prices will lead to energy rationing, which will lead to headwinds or limited ability to manufacture these chips that are then being imported into the US and are such a huge driver of economic growth right now. If that would start to happen, it would be another very negative outcome, which also means there's more incentive to wind down this conflict and start to allow oil prices to settle back down again. So keep an eye out for these two things. We're in April already. Elections are in November. In order for people are going to be out on the campaign trail fairly quickly. And so I would anticipate that we would start to see more. I know it's hard to accept that when you see the headlines as they are on a day like today. But there's going to be intense motivation for this administration to start to wind down the conflict. Okay, so how do you expect AI to influence earnings calls this year, particularly in discussions around productivity improvements and margin expansion? Are we still a year or more away from seeing widespread measurable adoption in day-to-day operations? So this is an area where we've spent a lot of time looking, and very interesting. So as you think about, we've looked back at like other technological revolutions to try and identify how long did it take for a new technology to start to show up in productivity. And in fact, there's something called the Solow paradox, which was introduced by Professor Solow, who studied the introduction of personal computers in the 70s and 80s, and won a Nobel Prize for coming up with an explanation for why PCs didn't actually improve productivity for another 10 years or so. And the answer is because it took a long time for, number one, companies to buy the equipment. It's a pretty big, expensive outlay. Employees had to be trained up on the new equipment. And then oftentimes work got slowed as people tried to understand how to put a PC into their normal workflows. So you had to actually take time to understand, how do I move this to, let's say, a word processor versus a typewriter? So all of that's to say is, AI came on ChatGPT was first available to the market in, I think, March of 2023. So we're a couple of years into this experiment. And up until last year, what we found was that the majority of dollars that were being spent by companies in order to build AI tools had not yet had a return. So in other words, they were trying out different things, but they weren't actually seeing productivity improvements. I would anticipate that the productivity improvement from AI will show up a lot more quickly than it did with personal computers, just because of the nature of the technology, right? It's so easy to interact with, and it's getting so much better day to day. I know I use AI a lot, and I think the sort of output that I'm getting today versus even 3 or 6 months ago is much, much better. So all of that's to say is that we are starting to see little signs of improved productivity in the macro data. We have seen, there are other measures that look at percentage of companies who are talking about AI, and many of them are talking about it and they're spending a lot of money and time on it, but can't yet sort of point to, oh, I was able to grow earnings this much because we implemented this AI tool. I would expect that over the next kind of year or so, you're going to see some more identifiable ways that AI has driven productivity. And don't forget, it's not always that a company hires fewer people. often it's they're able to innovate better, or they're able to go to new markets, or their employees are happier. There's been a lot of focus on the headcount impact of AI, but what we're seeing is that at least on the early side, it's not headcount so much as some of these other areas like innovation. So hopefully that was helpful. Let's see, is interest in AI likely to decrease as access to data sets becomes more restrictive and controlled? So this is really interesting. AI needs good data to be able to work. And you need to be able to not just access that data, but get the data to talk to each other. So I know a lot of companies are very focused right now on making sure that their data is in a really good place. Because without that, then you garbage in, garbage out. That said, and I think where you're headed is that not all the data that a company needs to be able to run an AI tool is available within its four walls, right? So I'm an investment analyst. I rely on market data to be able to make good decisions. And if I'm going to plug in an AI engine to be able to help me make better decisions, that AI engine needs access to, S&P pricing data or whatever it might be. What that means is that if you have a really good data set that a lot of people want, it's suddenly more valuable. And in fact, we've seen this even pre-AI, where there are certain data providers that suddenly have more pricing power than they have had in previous years. And I know, again, as a consumer of data, we've seen those data costs go up over time. I think yes, it becomes a big advantage to be able to own data that other people want, provided you can demonstrate and get people to believe that it is very reliable over time. That said, another challenge will be sort of like managing all these different AI tools, right? We have database administrators today who are cleaning that data and making sure it's correct. In the future, we'll also have AI administrators who are managing all of these different tools and making sure that they're talking to each other appropriately. Very interesting. Let's see, is there some differentiation for the length of geopolitical event and the rebound percentage? That is a really interesting question. And so we would have to go back over those 44 different events and calculate it. I haven't looked at it specifically. I'm going to guess that they're all over the place, though. But let us take that away and see if there's some interesting trend that we can see in terms of, how long does an event last versus how much downside do you see in the market in a short period of time. And it's interesting, like I think about the announcement of tariffs last year. That's not included as a geopolitical event in our calculation. But that's a good example of where you had this massive downshift in the market, and then and really, really negative short-term implications, but a very quick rebound. And so how would that compare with something else that maybe doesn't cause as much of a downturn, but lasts for a really long time? So let us take that away. I think that's all the questions that we have. So I want to thank everybody. I really appreciate the time. I hope you can tell I could talk about this stuff all day. I find it really interesting. But more than anything, we find it's really, really important that we provide really good information and a thoughtful approach to investing, because ultimately we want to help you achieve your financial goals and your dreams, and we take that as a really dear responsibility. So thank you for spending the hour with us. We will have this deck available for anybody who's still curious and wants to take a closer look at some of these images. But until next time, invest wisely and live richly.